It starts quietly. It starts quietly. A tiny shift in the bond markets, a subtle whisper in Wall Street boardrooms. But for nearly a century, this one signal has predicted every single major economic collapse with eerie precision. Economists call it the yield curve inversion, and those who understand it know it's far more than just numbers on a chart. It's a warning bell, a countdown clock that has echoed before the catastrophes of 1929, 2008, and now, in 2025, it's screaming again. Before we dive deeper, do yourself a favor. Hit that subscribe button, drop a like, and leave your thoughts in the comments below. Because what you're about to hear isn't just speculation, it's history. And history, as we know, doesn't forgive ignorance. Let's travel back to 1929. The Roaring Twenties seemed unstoppable. Stock prices were climbing at a pace nobody had ever seen. The consensus was that the party would never end. But behind the scenes, the bond market was telling a completely different story. Short-term interest rates began creeping higher than long-term rates. This is a rare phenomenon, the inversion of the yield curve. At the time, analysts barely noticed. Margin traders laughed it off. It was just a blip on the radar. Yet, that small, quiet inversion preceded one of the most devastating crashes in history, wiping out 89% of stock market wealth in a matter of months and plunging millions of people into poverty. The Great Depression wasn't an accident. It was announced in advance. Now, let's fast forward to 2006. The global economy was humming along. The housing market was booming. Everyone was making money. But once again, silently, the yield curve inverted. The signs were there for anyone who cared to look. The data was screaming warnings about an unsustainable housing market, excessive leverage in the system, and a fragile, interconnected banking system. By 2008, the world woke up to a nightmare. Trillions of dollars vanished overnight. Historic banks collapsed, and the global economy teetered on the very edge of a complete depression. And here we are, in 2025. The curve has inverted yet again. But this time, the situation feels different. It feels more precarious. National debt levels are higher than at any point in history. Inflation has been volatile and unpredictable. Central banks around the world have been printing money at a rate that would have been unthinkable just a decade ago. The exact same pattern that doomed Wall Street a century ago is forming right before our eyes. Only this time, the variables are far more dangerous and interconnected. What makes the yield curve so terrifying and so reliable is that it's not something that can be easily manipulated. It isn't driven by politicians trying to win an election, or by media hype, or by short-term market optimism. It is a pure reflection of the collective expectations of the market. We're talking about investors with trillions of dollars at stake, signaling their deep-seated doubts about the future. When short-term bonds start yielding more than long-term bonds, it's sending a very clear message. It tells us that investors are so worried about the immediate future that they demand higher returns for short-term risk than for locking their money away for 10 or 30 years. It means confidence is collapsing and fear is rising, often months before the rest of the world even realizes a storm is coming. And history proves it time and time again. Every single recession in modern history, every stock market crash, every financial panic has been preceded by this signal. There are no exceptions. Ignoring it is like setting sail straight into a hurricane, while believing the skies are clear just because the sun is shining at that moment. So, why is it happening again now? Why is the yield curve flashing danger signs louder than ever before? The simple answer is that the system is stretched to its absolute limits. Global debt has reached historic, mind-boggling highs. Corporate leverage has ballooned to unprecedented levels, meaning companies are more indebted than ever. Meanwhile, for the average person, savings are evaporating under the pressure of inflation. The artificial money printing over the last decade and a half has created illusions of wealth. It's fueled speculative bubbles in nearly every sector you can think of, from tech stocks to real estate to cryptocurrencies. Everyone feels richer on paper, but the foundations are built on sand. This isn't just about economics, it's about human behavior. It's about greed, denial, and the dangerous belief that this time is different. Those four words have preceded every financial disaster in history. We think we're smarter, that our technology has made us immune to the cycles of the past. But human nature doesn't change. And if we don't pay attention to the clear, unambiguous warnings that the market is giving us right now, history is poised to repeat itself. But this time, the consequences could be far larger, far more widespread, and far more painful than anything seen in living memory. The numbers are bigger, the world is more connected, and the fall could be much, much harder. Have you ever heard of a signal that has predicted every single major economic crash of the last century? No, it's not some mystical crystal ball or a top-secret algorithm. It's something called the yield curve, and right now, it's flashing red alert. To understand its chilling warning, we need to break it down. At its core, the yield curve measures the difference between short-term and long-term interest rates on government bonds. Think of it like this. If you lend money to the government, you'd normally expect a higher interest rate for a longer loan, say 10 years, compared to a shorter one, like 2 years. That makes sense, right? You're tying up your money for longer, so you want a better reward. This is a normal, healthy yield curve. But what happens when this relationship flips upside down? When short-term rates become higher than long-term rates? This bizarre situation is called a yield curve inversion, and it's a powerful, historically accurate signal that investors believe the economy is headed for trouble. It's a sign that the market collectively thinks the near future is so risky that they'd rather lock in lower returns for the long haul just to be safe. Let's travel back in time to see this in action. The year is 1929. The Roaring Twenties are in full swing. The stock market is soaring, people are getting rich overnight, and the party seems like it will never end. Yet, underneath the surface, a subtle signal appeared. The yield curve inverted. It was like a canary in a coal mine, quietly warning of the toxic air. For those who understood it, the message was clear. The economy was built on a house of cards. Reckless credit expansion, wild speculation, and mountains of debt were creating massive instability. People were borrowing money they didn't have to buy stocks, and banks were lending as if there was no tomorrow. But the vast majority of people, blinded by the illusion of perpetual growth, ignored the warning. Then, the bell rang. The market crashed, and it was too late. The Great Depression began. Fast forward to 2006. The housing market was booming. Everyone believed real estate was the safest investment you could make. Prices only went up, or so they said. But once again, the yield curve inverted. This time, the warning was even clearer. The housing bubble, inflated by risky subprime mortgages and complex financial products nobody really understood, was about to pop. Economists and financial journalists sounded the alarm. They pointed to the inverted curve as undeniable proof that a crisis was brewing. But just like in the 1920s, mainstream belief in endless growth was too powerful. Investors ignored the signal. Banks doubled down on their risky bets. The Federal Reserve tried to manage the situation, but their actions only delayed the inevitable. When the crash finally hit in 2008, the shockwaves were felt around the world. The global financial system nearly collapsed. Millions of people lost their jobs, their homes, and their life savings. It was a brutal lesson in what happens when we ignore the market's most reliable warning sign. And today, you guessed it, the same signal is flashing once more, and it's brighter than ever. But this time, the stakes are even higher. The global economy is larger, more interconnected, and arguably more fragile than it was in 2008. Global debt has ballooned, tripling since the last crisis. Central banks have already used most of their ammunition, with interest rates near historic lows for years. They have far less room to maneuver this time around. Today's market optimism is built on a different kind of illusion. It's built on tech bubbles, digital currencies, and a seemingly unshakable faith that printing more money can solve any problem and substitute for real, sustainable economic growth. But the yield curve is telling us that these assumptions are dangerously false. It's warning that the foundation is cracking. Understanding the yield curve isn't just about crunching numbers, it's about understanding psychology. When investors, big and small, start demanding higher interest for short-term loans than for long-term ones, it reflects a deep, collective fear about the immediate future. This isn't just one pundit's opinion or some hyped-up media headline. This is the voice of the market itself. It's billions, even trillions of dollars, all moving in a way that signals distrust, risk aversion, and extreme caution. History has proven, time and again, that when the market collectively doubts the future this strongly, a recession or a crash is almost certain to follow. But some people might ask, can this signal be wrong? Couldn't this time be different? Maybe 2025 will be the year it breaks the pattern. History's answer to that question is a firm and resounding no. Every single yield curve inversion in the United States over the last century has been followed by a recession. Every single time. There are no exceptions. The only real uncertainty is the timing, exactly when the downturn will begin and how severe it will be. But the pattern itself is consistent, relentless, and frankly, frighteningly accurate. The lag between the inversion and the recession can vary. Sometimes it's a few months, other times it can be over a year. This lag is what often fools people. The economy might still look strong on the surface. The stock market might even continue to hit new highs. This creates a false sense of security, leading people to believe the warning was a false alarm. But it's a trap. It's the calm before the storm. So, what does this mean for you? It means that if you want to understand where the economy is headed and potentially protect yourself from the next economic collapse before it arrives, you need to pay attention. Don't just listen to the talking heads on the news. Look at the data. Watch the bond market. Listen to what the yield curve is telling you. It whispers truths that headlines often miss. This isn't about panic. It's about preparation. Understanding this signal gives you the power to see what might be coming and make informed decisions about your finances, your investments, and your future. Ignoring history has always been an expensive mistake, and the yield curve is history's most faithful messenger. The warning has been issued. The question is, are we listening this time? The yield curve today isn't just inverted, it's screaming. Short-term rates are higher than long-term rates across multiple countries, from the US to Europe to Japan. This is not a small anomaly. It reflects systemic risk, over-leverage, and a fragile global financial ecosystem. Consider debt levels. Sovereign, corporate, and consumer debt have all reached record highs. Inflation remains unpredictable. The Fed and other central banks are caught between a rock and a hard place. Raise rates to fight inflation and risk crashing markets, or keep printing money and risk destroying currency value. Either choice feeds instability. History also teaches us that markets often panic long before economic fundamentals collapse. In 1929, the yield curve inverted months before the stock market fell. In 2008, the curve inversion signaled the housing meltdown long before Lehman Brothers collapsed. The lesson is simple. The warning comes early, and the consequences hit fast. The stakes today are higher than ever. The global economy is interconnected, financial instruments are more complex, and digital platforms have accelerated the velocity of money and panic. The signal is clear. Systemic risk is building, and the next downturn could cascade faster and further than anyone anticipates. The psychological element is just as important. Investors and governments often assume that we've learned from the past, but human behavior is predictable. Greed, denial, and overconfidence always precede disaster, and the yield curve measures exactly that. Collective fear versus collective optimism. When it inverts, the optimism is broken, replaced by growing doubt that eventually becomes panic. So what can we do? The first step is awareness. Study the curve. Understand the historical precedents. Diversify. Prepare. This is not about panic, it's about insight. The yield curve is more than just a line on a graph. It's a historical compass pointing toward risk, and the warning for 2025 is unmistakable. The signal is there. The pattern is there. And if history continues to rhyme, the coming recession may be deeper, faster, and more global than anything in living memory. History doesn't whisper twice. Those who listen early have the chance to act. Those who ignore the signal pay the price.